Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 146, and in this episode we are reviewing the performance of the global markets during the 6th week of 2025, and that is from Monday the 3rd to Friday the 7th of February. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where the number of new jobs created was lower than expected in the month of January, even though the unemployment rate edged lower and workers' wages rose sharply. According to the Bureau of Labor Statistics, non-farm payrolls increased by a seasonally adjusted 143,000 new jobs in January, and this was down from an upwardly revised number of 307,000 in December 2024, and was also below the consensus forecast for 169,000 new jobs. Nevertheless, the unemployment rate somehow managed to tick down lower to 4%. The January jobs report also featured a significant downward revision to the total payrolls for 2024, as it reduced the jobs count by 589,000 jobs in the 12 months through to March 2024. Staying in the United States, Federal Reserve officials usually take great pains not to comment on fiscal policy, but the looming threat from trade tariffs is forcing them to reconsider their stance. In recent days, several central bank policymakers have raised the issue of increased uncertainty brought on by President Trump's broad-ranging trade tariffs and their potential impact on inflation. And any indication that trade tariffs are putting further pressure on prices means the Federal Reserve will continue to hold its policy rate higher and possibly for much longer. In the Eurozone, according to flash data released by Eurostat, the Eurozone's annual rate of inflation rose to 2.5% in January 2025. That was a slight increase from December's 2.4% and was higher than what the economists had predicted, which was that inflation would hold steady at 2.4%, but a rising energy cost pushed that number higher. Meanwhile, core inflation, which excludes volatile food and energy prices, these remain unchanged at 2.7% in January and has held at that level since September 2024. And this suggests that underlying price pressures have stabilized in recent months. Another key metric to watch is services inflation, which is closely monitored by policymakers. This rate ticked down to 3.9% in January, down from 4% in December. So what this means is that rising energy costs are driving up overall inflation higher, whilst core inflation and services inflation are showing more stability. In the United Kingdom, on Thursday, the Bank of England announced a 25 basis point rate cut, bringing its benchmark policy rate down to 4.5%. This decision, however, wasn't unanimous, with 7 members of the Monetary Policy Committee voting in favor of the cut, whilst the other 2 members wanted a bigger reduction of 50 basis points. The Bank of England Governor Andrew Bailey made it clear that this was not the end of the road, as he told reporters that the central bank is expected to make further rate cuts later this year. In the meantime, even though exact numbers weren't specified, the Bank of England downgraded its growth forecast for the United Kingdom in 2024, highlighting concerns about the country's economic outlook. In summary, lower interest rates could mean cheaper borrowing costs for consumers and businesses as the Bank of England tries to stimulate growth given the challenging economic environment. On Wall Street this past week, stocks slid on Friday, driven lower by a mix of news related to both tariffs and inflation, which raised concern amongst investors towards the end of the week. All the 3 major benchmarks took a step down during the session after President Trump said that he was planning reciprocal tariffs on trading partners. This could mean raising tariffs across the board with a view to matching the rates charged to the United States. Friday's losses left all the 3 major averages in negative territory for the week, with the Dow Jones Industrial Average falling by 444 points to close at 44,303, whilst the S&P 500 declined by 0.95% to end at 6,025, and the tech-heavy Nasdaq slid by 1.36% to settle at 19,523. In the U.S. Treasury bond market, the yields on U.S. Treasuries were higher on Friday as consumer sentiment towards future inflation worsened, and the January jobs report showed a higher than expected increase in wages that could put further pressure on consumer prices. The University of Michigan Consumer Sentiment Survey for February showed that respondents expect the rate of inflation to increase to 4.3% in the next 1 year. Consumers are more worried about near-term inflation as President Trump continues to push aggressive tariffs against major trading partners. The yield on the benchmark 10-year Treasury rose by 5 basis points to 4.489%, whilst the yield on the policy-sensitive 2-year Treasury note notched up 8 basis points and was last seen trading at 4.289%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the crude oil market, the price of crude oil was down for the week after new sanctions were imposed on Iran's crude oil exports, and as investors remain concerned about President Trump's threats of tariffs and the potential risk of a trade war between the United States and its major trading partners. In an incremental move to increase pressure on Tehran, the U.S. Treasury announced on Thursday that it was imposing new sanctions on tankers that help to ship Iranian crude to China. Normally, the imposition of tariffs should be bullish for the oil market because it adds to the overall price of the commodity. However, the response has been bearish because of demand concerns. According to energy experts, the ongoing tit-for-tat response on tariffs will lead to higher prices that will ultimately reduce the global demand for crude oil. In response to the foregoing, the price of the global benchmark Brent crude fell nearly 3% this past week to settle at $74.66 a barrel, whilst the price of the U.S. benchmark West Texas Intermediate crude was down about 2% for the week and eventually came to a close at $71 flat per barrel. In the precious metals market, the price of gold rose on Friday and was on track for a sixth consecutive week of gains as escalating trade tensions between the United States and its major trading partners prompted investors to seek refuge in this safe haven asset. Earlier this week, President Trump kickstarted a trade war as he followed through on his threat to impose duties on China. Meanwhile, Trump has granted Mexico and Canada a one-month reprieve. Gold is used as a safe haven investment during times of political and financial uncertainty and rose to an all-time high of $2,882 on Wednesday, and this was on the back of concerns about a possible trade war. The price of spot gold eventually closed out the week at $2,862 per ounce. In the cryptocurrency market, in a risk-off move, cryptocurrencies tumbled at the beginning of the week after President Trump announced trade tariffs against Canada, Mexico, and China. Whilst many crypto investors view Bitcoin as a hedge against inflation and uncertainty over the long term, in the short term, Bitcoin trades like a risk asset and is therefore likely to continue responding negatively to any uncertainty triggered by Trump's trade tariffs. According to Coinmetrics, the price of Bitcoin fell from above $102,000 before the weekend and was last seen trading at around $95,700 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the Central Bank's Monetary Policy Committee, which met on Wednesday, the 5th of February, and decided to lower the central bank rate by 50 basis points from 11.25% to 10.75%. And in a further demonstration of its commitment to bring down interest rates, the Monetary Policy Committee decided to reduce the cash reserve ratio by 1 percentage point from 4.25% to 3.25%. For more details on the Monetary Policy Committee meeting, please listen to the topical issue at the tail end of this podcast. In the domestic foreign exchange market, during the past week, the Kenya shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.19 compared to 129.25 that was recorded the previous week. Meanwhile, the sterling pound was priced at 161.37 and the euro was valued at 134.21. And on the regional front, one Kenyan shilling was changing hands for 28.48 Ugandan shillings and 19.85 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.76. The Kenya shilling continues to trade within a very narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the long term, the outlook for the Kenya shilling remains bleak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves recorded a prodigious increase of $342 million for a grand total of $9.219 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that the central bank currently does not provide any explanation for the change in forex reserves. However, in the spirit of transparency, I have written to the central bank requesting them to provide more information on the change in forex reserves, especially when there is a significant change of more than $50 million, and I will keep you posted on the progress. In the interbank market, the liquidity situation in the interbank market improved significantly during the past week following the reduction in the cash reserve ratio, and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this fell significantly by 53 basis points from 11.23% the previous week down to 10.70%. And in terms of volume, the average value that was traded in the interbank market, this declined from 23.4 billion shillings the previous week down to 11.9 billion shillings. Meanwhile, the excess reserves held by commercial banks in relation to the new cash reserve ratio of 3.25%, this stood at 17.3 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 6th of February, and the central bank received bids totaling an impressive 71.18 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 296%, and the results of the auction were as follows. The 91-day rate continued to fall as it dropped another 40 basis points to average out at 9.11%, whilst the 182-day rate finally capitulated and dropped by 50 basis points to level off at 9.51%, and last but not least, the 364-day rate followed suit with a dip of 55 basis points to settle at 10.75%. In the secondary bond market, in an extremely rare move, the Central Bank of Kenya has published a prospectus for the buyback of 3 fixed coupon treasury bonds That means the central bank is offering to buy back these bonds from the current holders in the secondary market. The details of the three treasury bonds are as follows. The first bond is FXD1/2022/003 with a coupon rate at 11.76%, and this bond matures on the 7th of April 2025. The second bond is FXD1/2020/005 with a coupon rate at 11.66%, and this bond matures on the 5th of May 2025. And the third bond is IFB1/2016/009 with a coupon rate at 12.50%, and this bond matures on the 12th of May 2025. The period for the buyback is now open until Monday the 17th of February, and current holders who wish to liquidate their bonds are invited to submit their bids to the central bank during this window. In the financial headlines this past week, on the issue of pending bills, the Pending Bills Verification Committee has completed the verification for pending bills amounting to 474 billion shillings out of the 663 billion shillings that was initially submitted. And there now appears to be a light at the end of the tunnel, as the Treasury Cabinet Secretary, John Buddy, announced a new plan to clear about 206 billion shillings in historical bills, and this new plan would prioritize the payment of small suppliers who are owed up to 10 million shillings. In other news, the Treasury Cabinet Secretary confirmed on Wednesday that Kenya has started fresh talks with the International Monetary Fund to secure a new lending program after the current one expires in April 2025. Kenya needs continued support from the International Monetary Fund in order to keep its economy on track after its debt servicing cost increased exponentially following a reckless borrowing spree over the past decade. Additionally, the government has abandoned plans to raise revenue through new taxes after the Finance Bill 2024 was withdrawn following demonstrations across the country. Staying with the headlines, Safaricom Telecommunications Ethiopia began offering M-Pesa services in August 2023, and in the 12 months to December 2024, the number of M-Pesa customers in Safaricom Ethiopia has more than tripled from 3.1 million to 10.8 million. This increase was driven by usage of the platform for the purchase of airtime and data, as well as cross-border money transfer services. And the last headline catching our attention this past week, the Treasury has backed the introduction of a new bond trading platform that would allow investors to trade Treasury bonds outside the Nairobi Securities Exchange. The privately owned platform, which is referred to as the East African Bond Exchange, received its operating license from the Capital Markets Authority in February 2024. This decision to back the new platform places the Treasury and the central bank at odds, given that the banking regulator has raised concerns over the second bond trading platform. The central bank has expressed concerns that the dual platforms will distort the market through the creation of duplicate prices for the same bond. Up next is our topical issue. And this week, we are reviewing the outcome of the Central Bank's Monetary Policy Committee meeting. The Monetary Policy Committee met on Wednesday, the 5th of February, and reviewed the outcomes of the previous measures implemented to anchor inflationary expectations and maintain a stable exchange rate. The committee met against a backdrop of an improved global outlook for economic growth amid lower but sticky inflation in advanced economies and persistent geopolitical tensions. Global growth continues to recover and is projected to improve to 3.3% in 2025 from an estimated 3.2% in 2024, mainly supported by strong growth in the United States and India. Global headline inflation has moderated, but the pace of decline has slowed down due to sticky inflation, with the major central banks weighing between further easing of monetary policy and the risk of higher prices due to rising tariffs and persistent geopolitical tensions. Kenya's overall inflation stood at 3.3% in January 2025 compared to 3% in December 2024 and remained below the central bank's midpoint target rate of 5%. The performance of the Kenyan economy slowed down in the third quarter of 2024, with the gross domestic product growing at a rate of 4% compared to 6% in the third quarter of 2023. The growth of the economy in 2024 is estimated at 4.6% compared to 5.6% in 2023. The banking sector remained stable and resilient with strong liquidity and capital adequacy ratios, as the ratio of gross non-performing loans stood at 16.4% in December 2024. However, commercial bank lending to the private sector contracted by 1.4% in December compared to the previous year, mainly reflecting reduced demand due to high interest rates. The committee further noted that economic growth decelerated in 2024 and therefore there was scope for further easing of monetary policy in order to support economic activity. The committee therefore decided to take two actions. The first was to lower the central bank rate by 50 basis points from 11.25% to 10.75%. And the second action was to reduce the cash reserve ratio by 100 basis points from 4.25% to 3.25%. The Monetary Policy Committee noted that the reduction in the cash reserve ratio will release additional liquidity to commercial banks, and this is expected to lower the cost of funds and support lending to the private sector. The committee will meet again in April 2025. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the only person you should try to be better than is the person you were yesterday. Think about it. Thank you, and God bless.